Good evening, everyone, and welcome. My name is Anka Metcalf, and today we will be talking about profiting from market volatility. We did have some volatility. We had a volatility influx, and that was partly because of the events that happened at the end of the quarter. So it shouldn't be any surprise that these events happen on a cycle, and we're going to talk a little bit about the cycle. I'm going to show you some charts. I have alerted my traders, and not only my traders, but everybody. I have a blog, and we did actually mention this rotation that happened. We mentioned the rotation on September 10th. Whoops, that's it, 13 days ago. All right, we played the downside and we are playing the upside right now. So profiting from market volatility, unlimited income, and simple patterns. So for those of you that do not know me and are listening to me for the very first time, my name is Anka Metcalf, and I'm the CEO and founder of TradeOutLoud.com, which is a trading education firm that is specialized in educating individuals how to day trade and swing trade the futures and the equities market, also on the investing side as well. I have been a professional trader for more than 17 years, and I come with 10 years in investment banking. I specialize in high velocity moves. So with that means is that I look for pressure points in the market, and I look for the maximum gains for the risk applied. I'm the designer of an institutional proprietary trading system. So technical analysis has been around forever, so I cannot take credit for it, but my system is a little bit more complex in the sense that I don't look at just supply and demand. So if you're just looking at supply and demand, you're missing the rest of the 85% that is out there, and that gives you that precision in trading, that precision to the tick, to the cent, exactly, so to the cent. So I'm going to give you an example. This week, we actually mentioned it on our Twitter feed that we were shorting the mini S&P, and we nailed it to the very tick. So that is public information. You can see it out there, but we also had the trade in the Qs in S&P, and we also had it in NASDAQ futures and Russell. So it worked beautifully with huge profits. It was the biggest day. The drop before the FOMC was actually the biggest day this week. So price support resistance, like I said, only represent about 80% of the equation. Yep, that's it, 80% of the equation. I also have developed specific trigger times for the day trading because I'm all about precision. Trading is precision. It's not about, oh, I think I'm going to buy here. I'm going to scale in a little bit here. I'm going to scale out a little bit there. You either know how to trade or you don't know. So these specific timeframes are designed for the New York trading session trader, and they will amplify your knowledge and your accuracy into your entries, your stops, and your targets. We do also have specific price zones. These are the best institutional kept secrets. There are 4 precise price zones throughout charts where institutions leg in and leg out. Wouldn't that be sweet to know where those points are, right? All right, so we know what there are, and we know that we can capitalize on ins and outs based on those 4 precise levels. And they're the same whether you're trading stocks or futures or Bitcoin or whatever it is. And also chart synchronicity and divergency is very important because you're not going to get follow through and you're not going to get your desired targets if you do not have a correlated market. A correlated market means that for example, the ETF, the Qs, the SPYs, the diamonds have to move in sync. Or if you're trading futures, mini, NASDAQ, the S&P, Dow, and Russell need to move in sync. And sometimes they're not all moving in sync, but once they find their mojos at the calibration in the morning, then they start rotating a little bit and moving to the upside. So if you have any questions throughout this presentation, please feel free. I'm going to look at the chat box, and if you have any questions, I am really happy to answer your questions. So if you want to get a hold of us, our website is Trade Out Loud. You can reach me on Facebook on Trade Out Loud, on Twitter, Trade Out Loud. And in fact, I do use Twitter to actually point out some of the trades before they happen and never after the fact. You can view our videos on YouTube or LinkedIn. Here's my agenda for today. Advantages of futures versus stocks. I trade both. I love both. To trade both. I love trading stocks, and this is actually how I got started into trading on the investing side, swing trading side, and now on the day trading side for the last 17 to 18 years. And I have transitioned into futures for accounting purposes because of taxes, obviously. The steps you need to take and to protect your portfolio. So listen, if you need to use protection for your portfolio, then you are overly invested. So it is really wise to use some stops along the way, to trail stops. So you can definitely scale out into targets. So you can, when you have the market turn around, it wouldn't catch you by surprise. But I also show how you can use the VIX to hedge your portfolio. This is something that we did this, not this week, but last week and this week. We had position in the VIX and SQQQ. Also, volatility is here to stay. I'm going to show you how and why this volatility is here to stay. So volatility is not going anywhere. So if you're thinking that, yeah, it's going to subside, it's not. Okay, so we have a lot of things that are played going into next year. Also, technicals are working, right? So are technicals still working? Is this still a technical market? Well, I'm going to answer that question. And then we're going to talk a little bit about day trading versus swing trading in volatility, right? In volatility and how to adapt as a trader. So if you lost money in the 2008 market correction, which some of you guys are really young and may not remember the 2008 correction, or maybe you were not in the market. I was in the market. I've been trading for a very long time. I traded and I thrived in 2008. And that is actually when I was thinking about putting the foundations of TradeOutLoud. TradeOutLoud is a company that was founded in 2010, but I was sharing my trading ideas with many, many traders. We had groups on Skype. We had many other groups on different other avenues and Skype. Anyways, I'm not going to get into that, but we were I was very active into sharing my trading ideas, and that's how TradeOutLoud came about. So if you lost money in, let's say in 2008 or in 2010, make 2020 and 2021 pay. In fact, last year, I had the most massive year on record because last year we had a plethora of opportunities. Guess what? Because of the pandemic and because of the opportunities that came with that came with the volatility, right? Volatility creates opportunities, but only for the knowledgeable trader. So advantages of futures in volatile markets and advantages of stocks in volatile markets. Well, first of all, let's talk about the advantages of futures, right? Because like I said, I've been trading futures. I think I'm going on the 9th year in which I am day trading futures. So I trade futures for about 2 hours every day. Mostly I focus for about an hour and a half and I'm done. So that is my whole work day. So basically, I don't work a lot on futures. So if I see the pattern, I trade it. If I don't see the pattern, so it's very simplified trading. We're going to talk about that later. And then I swing trade stocks. And swing trading, you don't have to babysit your computer. You don't have to babysit the charts. You set the trade and set it and forget it. You have complete management. It's on total pilot. You know where your entry is. You place your entry. You place your stop. You place your target. You place your profit target. You're done. I'm out the door. So let's talk a little bit about futures. So in futures, the minimum account, no minimum account. So as you know, if you want to become a day trader, if you want to day trade stocks, you need at least $25,000 to be able to start day trading stocks. But you need a little bit more than that, because if you lose, for example, a penny, and if you go below 25,000, then guess what? Your day trading status is out the door. So in futures, you're trading major market indices, and this is a huge advantage. You need about an account of $5,000. The minimum required is about $5,000, and you can trade big markets like the S&P, like NASDAQ, like the Dow, Russell, crude oil, bonds, gold, and other commodities, unlike individual stocks, which are small components of the indices. So these are advantages and disadvantages. So when you're having a really big dynamic move, for example, in NASDAQ is going to move 10 times faster than the Qs. All right. So basically trading major markets is a big asset and, one of the biggest advantages for the futures market, and also the account size. Like I said, the minimum requirement to day trade futures or to swing trade futures is $5,000. Also, you can trade it for income and wealth, day trading and swing trading. You could even invest, and this goes for both, for stocks, and also is applicable to futures as well. Day trading is an income producing style of method because you're basically day trading an hour, 2 or 3 or 5, or how many hours you want to trade. It's totally up to you. My personal preference is I only trade the open because I specialize in the open. I have a great experience trading the open and I'm great at it. So I don't want to waste my time in the market in the afternoon. I have other things to do. So I also recommend swing trading. Swing trading is when you walk away, set it and forget it. And you could do both, day trade futures, day trade stocks, or definitely swing trade futures or stocks. Tick values and different price ranges. So for example, when you're trading futures, you have different values and different tick price ranges. So for example, the Dow, 1 point in the Dow is equivalent to 1 tick, and that is $5. If you're trading the mini S&P, 1 point is $50. If you're trading at NASDAQ, 1 point is $20. And sorry, I don't talk in ticks because I'm not interested in little micron ticks. So when we trade, we're looking and we're focusing on a plethora of points and not by the tick, but just to have you, just to give you an idea. There are many opportunities for small accounts because this is a volatile market and the setups are wide, the setups are big. And because the setups are big, it is a market for micros if you have a small account. So if you have, for example, a $5,000 account, you don't go near a full-size contract. You don't go near a full-size contract, but you're going to trade micros and you have a whole advantage of that. I have traders that trade micros in my trading room. They average between $4,000 and $6,000 a month by trading that. You have reliable volume. It is a liquid market. So the futures market is a very liquid market. $600 billion daily turnover. That's huge, allowing instant execution. So what does that mean? You're not going to get flipped. Oftentimes I see a lot of traders, for example, that are focused on day trading stocks and they see the pattern, they see the trade and they go like, oh yeah, I'm going to get in. They execute at market and they're getting a big spread. The reason for that is because they have, sometimes they're picking very thin stocks that are trading 500,000 shares or less. When I day trade stocks, I day trade stocks that have at least 1.5 million on the day because I want to have a liquid market. I don't want any spread. So I'm looking for stocks that don't have spreads. So that's a totally different thing. But when you're trading futures by design, they're not spready because it's a massive market. So you don't have to worry about the volume before you get into a trade. You just focus on the pattern. Leverage, low margin requirements, and very low commissions. And as you know, very low commissions, and nothing comes free, guys. So for example, in the stock market and even TD Ameritrade does not charge me anything for commissions, but guess what they do, guys? All of these brokers that do not require any kind of commission for trading stocks, they sell our data to whom? Well, to hedge funds. So they know exactly where we are, to algorithms. Have you seen like a lot of times when you're in a trade, they push the price down and then they take you out? Maybe it goes like, maybe like 2 to 3 cents or 2 to 3 ticks below, and then it rotates back to the upside. How many times has this happened to you? Just type a 1 in here in the chat box and let me know how many times has this happened to you, because it happens super fast. And if you're wondering why, these are called forced sells and then buys, right? So what they do is they flush the price and then they buy it from you because they know they want to push it higher, but they want to get their hands on more contracts. They want to get their hands on more shares. So one of the other biggest advantage is that you do not require a scanner if you're trading futures, because guess what? You're only trading the major indices, or you're trading indices and you're trading some commodities. You could go on finviz.com and you could click under futures and you could see everything that you're trading there. There's a panel that fits in one little page. So there are just very few things that you can trade because basically you're trading huge markets. The other thing is that you don't need a special indicator. Okay. And going back to the scanner. So what I wanted to mention is that when you're day trading stocks, you need a scanner. I have two scanners because when I trade and when I swing trade, sometimes, I like to trade some stocks in the afternoon day trade. I like to scan for some stocks for the next day or even for that certain day. So I use a scanner. Why? Because the scanner is my assistant. It finds opportunities for me. It finds leaders and laggards, bases. It finds climactic trades. It finds a plethora of trades that interest me and my style. But if you're trading futures, you don't need a scanner. You're a day trader, for example, or a swing trader in the stock market, you need a scanner. That could be an $180 to about $250 or $280 a month expense. So I'm telling you that futures is a really good way to get started into trading because it gets you a lot more focused. And by the way, if you learn how to trade futures, trading stocks is going to be a walk in the park. You're going to go like, oh, you know what? It's just too easy. All right. So the other thing is that you don't need any special indicators. Stop using indicators. Stop buying indicators that are going to delay your learning process. Do you really think that there's an indicator on the planet that is going to tell you exactly where to buy, where to put the stop, where to trail at? No, it's not. I mean, think about these institutions and think about the hedge funds. Don't you think that if they would have had like an indicator, they would have sold the indicator or they would use an indicator that does that? But no, they're old school. They look at chart patterns, they look at technicals, and that's pretty much it. So keep it super simple when it comes to trading. The other thing is tax advantages. Like I said before, this is the one thing that I was advised by my financial planner and by my accountant to go into the futures market because the taxation is different. You can browse it or you can ask your accountant or financial planner. And you have very simplified reporting at the end of the year. You have a 1099-B form and that's it. There's only one sheet of paper compared to stocks where you have a plethora, you have all the trades, et cetera, et cetera. So you have a whole file and your accountant it's going to charge you an arm and a leg to do your taxes. All right. So then at the end of the year, then you have the 60-40 rule here in the US. If you're living in the UK or outside of the United States, you're rocking because you're going to pay very few taxes if you're trading futures. You can take a short position with these. You don't have any uptick rules. There's no pump and dump. It's safe from rumors, no manipulation, no downgrades, no upgrades. It's great for hedging. Wow, wait, what? Oh yeah, it's great for hedging. So for example, if you're very long the market and if you want, for example, exposure, and if you want to hedge, you can hedge on with, for example, either with the VIX futures if you want. I don't do that personally, but I know a lot of traders that do that. Or you could do SPX, for example. You could do the S&P, mini S&P. So you could take short the mini S&P as you're hedging your long positions until you're in the clear. The one thing that I really like is that it's a 24-hour market. So even if you have a full-time job, when you come home, you could still look at the market, and the market is still very, very volatile and has good volume, even outside of the New York trading session hours. And it's a hands-on risk. So for example, if there's an event that is happening, for example, overnight, because remember, the markets are not going to wait for the market to open at 9:30 in the morning. Events happen. That's why you're seeing a lot of gaps up, a lot of gaps down in the New York session market. And that's because the overnight markets are dictating pretty much where they want to go. All right. So with that being said, let's get on to the advantages. Another advantage of the futures markets. I'm going to give you a brief example. Let's say, you want to trade the Qs, and let's say the Qs are priced at $280 and you're going to need about $14,000 to buy 100 shares. Now, if the price goes up 50 cents, you're going to profit $50 because each cent is $1. Now, if the trader wants to buy the mini NASDAQ, let's say they're priced at 11,500, the trader needs about $17,000 to buy one contract. And because of the 2020 pandemic volatility, because it was not always like that. So all you needed was about $3,000 to $5,000 in order to trade that, for example, NASDAQ. So if the price goes up 50 points, then you're going to make, guess what? Instead of $50, you're going to make $1,000. So like I said, trading more is actually making less, and the risk is the same on both. All right. So let's take it here and let me show you what I'm talking about. So this is the chart of the Qs. Now we executed this trade right off the right into the open here in the morning session. And guess what? We bought 100 shares, 321.91. You could see it right here. The price went higher and the buying power in effect here was 16,000. So you're using and this is the buying power in effect. Okay. So this is $16,000 and you made about, with buying power in effect, 16,000, you made $200. Well, if you think about it, it's great, right? But wait, there's more. Same trade, same setup. This is futures NASDAQ, same price location that we did in the Qs with the same entry, same parameters, exactly the same carbon copy trade, and applied it to futures market with one contract, buying power 17,000. We make $2,000, 10 times more. So would you rather sit, for example, 20 minutes or 30 minutes in a trade using the same buying power, using the same risk, making $200, or would you rather play with the big boys, play with the suits, and make $2,000 within the same amount of time? And the timing for the futures market is about 20 minutes. So we usually, get in and get out within 20 minutes or less, and we're done. Okay, and we do that almost every single day. All right, so in mini NASDAQ, so for example, I give you an example, and this is again for traders that have, let's say $30,000 or more in their trading account. But if you have an account that is $5,000 or less, you're going to use micros. You position size for micros, but here I didn't even position size. I just wanted to take 111, so 100 shares or one contract or one micro contract. So in this particular trade, we used about $1,700 in buying power, and this generated $181. This is about 5%. This is about 5% from that $5,000. So I just want to tell you something. I don't know if you're aware, but hedge funds, if you have your money with Goldman Sachs or any other hedge fund of your choice, your return per year is going to be between 7 and 8%. That's it, or I'm sorry, 6 to 8%. That's it. This trade generated over 5%. I'm going to show you some numbers a little bit later on. So biggest advantage for futures is monitor and manage positions 24 hours, no gap surprises except the halt and limit down when we had the pandemic, right? But that was so much fun trading. Trust me, it was incredible for a trader that knows technical analysis. It is amazing. And for stocks, you can have surprises, okay? And you're going to use more money and you're going to make less money than the futures market, but I still love it because I still swing trade. Where are we now and where can we expect the follow through? Well, we are right here, okay? You see this arrow right now? We have one more week. Next week, we're going to wrap up the quarter. We're done. We're done, guys. We're wrapping up the quarter. We're wrapping up the quarter, and we're going to have brand new candles on the monthly, brand new candles on the quarterly. It's going to be a very exciting time. A week from tomorrow. All right. So when you can expect when you can expect follow through in here, week 2, 3, 4. That's it. This is when you hit the pedal to the metal. Here, unique trades ahead of earnings. And don't forget that we have a lot of volatility. Usually September, August, September, and October are very volatile months. September by design is a pullback month in which we have the pullback. And then we're going to have a little bit of chop going into the beginning of October. And once we navigate outside of inside earnings season, so mid-October, we're going to begin earnings season. Things are going to start heating up. So let's talk volatility, right? Because that's why we're here. And this presentation should be all about volatility and about the VIX. So every once in a while, the markets will become volatile for various reasons: news, geopolitical events, elections, unrest, etc. So there are volatility cycles, right? So once you know that there are volatility cycles, all you have to do is be aware of that. So volatility, we had a volatility cycle in 2000 to 2002 when we had the internet bubble. Yes, I was there, I was trading. In 2008 financial crisis, traded and thrived. In 2018 volatility exposure spike. You guys know what it was about in 2018. It was the trade war between China and US. Huge volatility came in the market for the first time since 2009. So, oh my gosh, about 9 years, right? About 9 years, and we had huge volatility come in. We didn't know what volatility is. A lot of traders that began trading after 2009 had no idea what volatility is, and they blew a lot of accounts. And retail traders are not the only one that blew their accounts. I'm going to show you later on. Hedge funds closed their doors, many hedge funds. In 2020, we had the coronavirus pandemic, plus we had the election. So it was a very volatile year. By design, election years are volatile. Every 4 years, you can expect that. They usually trend up as you're going into election, and as you're into the summers, so from about July, end of July. So once you wrap up those 2 to 3 trading weeks in July, the market tends to go down because of the unknown. Nobody knows what's going to happen after the election. So people are traders want to take some profits. And then guess what, guys? When are we going to have the next volatility cycle? In 2022, midterm elections. So volatility is the amount of unpredictability or risk in an index, a stock, a commodity. A higher volatility means that a security's value can oscillate in a larger range of price. In other words, the price of the index, stocks, commodity, etc., can have a higher than average fluctuation rate over a very short period of time. It's called a chop fest. Chop, chop. All right. It goes slashing down and comes violently back up. So a lower volatility means that an index, stock, commodity, etc. value does not move dramatically, but at a normal pace. And like I said, we had years in which were really dull years. All right. So from 2009 all the way to 2018, it was like, okay, we're climbing, we're going up, we're going up, we're going up, and then boom, shake out volatility. This is the chart of the E-mini S&P. This is the day trade that we done in the trading room. We had massive profits on this. We shorted this. Here, and based on FOMC fears. And this is the point. Actually, we almost had it to the tick. So I had support here and I had a profit target, and we have a way of selecting profit targets, pure technical. And we're not talking about that here, but we had our profit target into 40 to 94.75. And we were literally like 3 to 4 ticks away from that. And we made a low into 93.75. That accurate. So when I'm talking about we're loving to get everything to the penny, all right, not the quarter, not the dime, right? We're literally getting everything to the penny. All right. So volatility, like I said, a lot of FOMC fears, market distributed here, was a huge profit opportunity. The other thing is that the acceleration of the move is lower. Why do you think the market dropped here? So yeah, FOMC fear, right? What do you think? Why do you think we had the accelerated move down? Well, first of all, it was caused by number one, trailing stops. So what do you think happened here? Everybody that was long, right? Everybody that was long from a prior position, they had their stops. Some of them had their stops here. Some of them had the stops. They had layers of stops, right? So when the market triggers those stops, it produces an avalanche. So the price goes avalanche, it snowballs down. It creates panic. And not only that, you have the stops that are getting triggered, the trailing stops that are getting triggered, but you're getting panic. So people sell on panic. So on top of that, you have short sellers, just like me, because I hopped in short, right? So I shorted. So you have people that are triggering out, and you have traders that triggering out rather, and you have individuals, traders, investors that are hopping into the shorting side. Then the other thing is like algos hit a really hard short positions under key levels. And that is exactly one of the biggest things that triggered this week. It was that key level that was broken. And then from that point on, the market didn't look back. And you have massive institutional liquidations because you liquidate, it's just synonymous with the trailing stops. So institutions have trailing stops as well. So they don't use hard stops, but they have trailing stops. So once they're up in the position, they trail. So they left their stop a little bit higher. So once those stops hit, they enter liquidations and they cannot exit all their positions at an exact price. So what they do is they snowball down. Okay. So they want to get out, they scale out. So that is a massive institutional liquidation. The other thing is margin calls, right? You have margin calls. Now, at the same time when we were long, we go like, oh yeah, we're going to get all piggy on this. Not only that we went short the S&P, but we went long the volatility. We went long the VIX. We had an instant gratification here in 2 days. We made so much money. You could see here at this base breakout over $26. You had from $26 to $32 profit. And that's juicy, juicy, juicy profit. So what causes volatility? All right. And what are the triggers? Well, geopolitical events, climactic hyperextended move in the market, similar to January 2018, or we had, remember the 2018, we went parabolic up. So right after the election, the market went up, 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 all those taxes that were cut, everything made an exuberation in the market and everything, the economy started to work out better. So the market went ballistically higher and it was very extended for any kind of support. It was very extended from any kind of projections, fib projections. So for that reason, the market started to have some jitters where in the location where it was levitating. You have earnings reports. Earnings reports always create a little bit more volatility. Events from Washington, every detail that is coming out from Washington, especially now, pay attention. So every little single detail that is coming from Washington, and by the way, we have huge news that is coming tomorrow, but thank God it's coming in right after the market closes, is the Arizona audit. So that is a huge, huge, huge thing. So you can expect a lot of market volatility to follow that news. And guess where that is going to be observed? In the futures market. When? On Sunday. So you may see a gap up or a gap down in the futures market, and that is going to create the volatility for the next week. Now, remember that next week we have the end of the quarter. Do you guys know what that means? You guys know how to trade the end of the quarter? Well, you don't pick bottoms. That's for sure. You don't, because those positions that are going into the end of the quarter, they're just going to be liquidated. Never buy bottoms and never try to outspot the market, because you're going to see window dressing effect. What is window dressing effect? Portfolio managers, hedge funds, are going to try to look super smart. So what they're going to be doing is that they're going to be ditching stocks like, I don't know, XYZ, for example, that has been beat up for the whole entire quarter. And they're going to pick up, let's say, Amazon or Google or Netflix that has been thriving throughout this quarter, right? And the client doesn't know how long he has been holding that position. And he goes like, oh, wow, that's nice. So I've been in NVIDIA all this time. But in the meantime, he was in a losing stock. But the manager sold his losing stock and hopped in to NVIDIA, for example. And he's going to go like, oh yeah, NVIDIA, I'm rocking it. Okay. So these are little tricks that institutions are using. So volatility, is volatility good or bad for the trader? Well, there are some pros, but there are some cons as well. Tremendous technical opportunities for the astute trader. Money's being made in a fraction of the time compared to the traditional market moves. So I basically made a week worth of profits into just one trade in one day before the FOMC on that liquidation. It's profitable for short-term trades, for day traders, extremely profitable. And as price seesaws back and forth, short-term traders can use chart patterns chart patterns and other technical indicators to help time the highs and the lows. But there are some cons as well. Okay, 95% of the traders blow up their accounts. That's it. The retail traders, you have to be really great when you're trading, because if you're average, you're going to lose money. So wide stops created by price and huge price fluctuation. So what happens if you're looking at a technical chart on smaller time frames? You're going to see that the setups are there. Traders are usually have photographic memory. They identify, for example, a buy setup, a bull flag, a breakout, whatever it is, and they go like, oh yeah, I'm going to go in. What happens is that they're placing the stops. And when they're placing the stop, they realize like, oh my gosh, that is a really wide stop, really wide risk. So what happens is that they're going to lower the risk. First of all, they're going to lower the risk. So they're going to kill the trade anyway, because in trading, you have to respect the parameters. You don't respect it, you're going to get really slapped. Okay. And a lot of traders are learning that the hard way, and you don't have to learn the hard way. There's an easy way to do that. Okay. You just learn about it. The second thing is position sizing. Traders do not know the importance of position sizing. If you don't know how to position size, do not trade. Shut down the computer and learn how to position size for the trade, whether stocks or futures. You need to know how to position size. Position size is going to blow up your account 100% of the time if you don't use it, not 95. So if you blew an account, you blew it because you had no idea how to position size. So once you learn how to position sizing is more important than the chart pattern and technical analysis accumulated, okay? And then setups become much more difficult to take because they're like so sloppy, right? They have really wide stops. It's totally fine. You don't have to trade. You don't have to push buttons when the volatility is there. Traders think that if the price is moving up or down, they need to be in a trade. Wrong. You need to trade only 10% of the time and watch the market and analyze it 90% of the time. So this way you incur multiple stop outs. Inexperienced trader can lose more money in volatile market conditions. Stops are very wide, making it impossible for retail traders to participate and impossible for small account holders to take any trades for days. And those are the pros. That's true. Now, here's a quick explanation. And actually, I had this chart. I gave this to CNBC. All right. So they love this chart. They showed it. Okay. So here it is. You have the growth concerns. And this was back in 2014. You have the China unrest. Do you remember the China unrest in 2015? I sure remember it. And Greece, remember Greece defaulting? Oh yeah, Greece defaulting. Everybody wanted to short, but then quickly went back up. Help came from the European Union, went back down, the price went back up. Falling oil prices. You guys remember 2016? Well, I remember it because in 2016, I was accumulating a lot of energy stocks. Yes, a lot of energy stocks. It happened on March 1st, 2016. And then you had Brexit. You remember Brexit, 2016. And then we had the US election back in 2016 in November. Here it is. Here's the rotation. And this is going higher. See, it was almost getting climactic, not really climactic, but it was almost getting climactic. Look how elevated the price was in 2018. Volatility, this is the 2018 volatility right here. Once we were outside of volatility, we had some quiet time all the way going higher. Guess when? Into September. This peak that you see here, guys, September. This is September. This is October. This is November and December. And this came in on the test, 200 simple moving average. Guess what day this is? Santa Claus rally. Yep, there is such thing. There is a Santa, and this is a Santa Claus rally. I specialize on this. I specialize on systems that hedge funds use. I had training from hedge fund managers, so I know how to identify buying opportunities when I see one, because I'm not following institutions. I'm trading with institutions. So here we had Santa rally. We went higher, we pulled back, and the rest of history. This is the pandemic. You can see it right here, ugly, messy. And this was the Black Swan event. This is it, the Black Swan event. We nailed the rotation, guys. We nailed the bottom. We had a divergence and we nailed the bottom. And ever since then, we were long. In fact, we were short for a very brief period of time. And then we went long. This is where the market is right now. And I'm here right now to tell you that we're setting up for a really bullish. That is, if we continue the trend a little bit higher tomorrow. And if we don't have a shock wave or a tape bomb tomorrow, you know what tomorrow is? Friday. You know what Friday is? Powell is speaking at 10 o'clock. That's right. Powell's speaking at 10 o'clock. I don't know what he's going to be saying. If he's going to spook the market, the price is going to go back down. If we close below the 20 SMA, we're going to be bearish. If we maintain the same parameters like here, and if we close a little bit above the 10 EMA, bullish. We're going to make new highs going into next week. By design, the window dressing weeks are bullish. And we have 4 days, Monday through Friday. On the 1st, we start a brand new quarter. So can you make money in volatility? If you can make money, you can lose it all, right? You can make more money or you can lose it all. Name of the game. You either know how to trade or you don't know how to trade. In 2018, 374 hedge funds have closed their doors. Guys, I'm talking about hedge funds, not me, not you that are trading from home. I'm talking about hedge funds, and they have the most brilliant minds and the most fastest computers, and the knowledge, their knowledge is unbelievable. But guess what? 2018, that volatility killed 378 hedge funds that were cocky. Go like, oh yeah, we can do this, we can do this, we can do this, and boom. Last year, 2020, 79 hedge funds have closed their doors. That's right. So if you have your money with some hedge funds, right, you may be subject to this kind of disaster. Roughly 11,600 hedge funds shut down between 2008 and 2020, according to Bloomberg. Wow, imagine those funds, guys. Imagine the billions that were lost in the market. Okay, so you can view our performance. Okay, you could definitely view our performance. If you okay, here it is. All right, so you can view our performance. You can click in here. So this is for the swing trader, and look at our results. Not only that we have results, but if you go to our website and if you click to the bottom of the page on performance, TradeOutLoud has been around since 2010. We have trades, all the trade records since 2010. And guess what, guys? We have been trading futures, and I've created the trading room to help every trader on every level make money. And we have created that in 2017. So we have records in 2017, all transparent. I'm not only talking about the market. So I'm not telling you, oh yeah, you know what? I could talk about the market. I could tell you, oh yeah, that's the simple moving average. The price may or may not go there, but if it does that, it's going to do this and that. I don't only comment about the market. I'm like laser sharp precision into the directional bias and providing everyone and our members with trades that they can take. Traders don't need the blah, blah, blah. Tell me where the market is and tell me what this and that. And oh, that oscillator, it turns me off. If I was a trader right now looking for a service that would provide me trades, and I would have someone that say, oh yeah, I'm going to tell you what the market is doing, but don't take any ownership, any responsibility. The service is equal to zero to me. Show me the money. This is what trading is all about. You have a performance sheet. Show me the money. Other than that, that service is useless. Okay, so be very careful what you sign up for. So this is the TOL stock swing trader. You can see all of our profits here. These are percentage gains, and actually these are the measured moves from entry to exit on each and every single trade. So for example, these are just the 2021 trades, okay, that you can see here. All right, and you could browse through them. And you could also see the trades that we're in right now. This is September 2021. Okay, these are the trades. Today we added UNG. And also you could do our day, you can see our day trading. Everything is 100% transparent in our system. So you could see from January 2021, but like I said, you could go from 2015 to current. We don't actually display the last month because if we have trades that are open and swing trades, we don't want to share them with everybody. It would be super unfair for the individuals that pay to be in the room and gain this knowledge. I do explain a lot of technical analysis and the reason behind the trade and behind the move. So for example, these are the totals, for example, in January, and these are the results are by contract, so per contract, these are the points per contract. So I'm not talking about 3 contracts here, 2 contracts here, one. No, everything is fully transparent per contract. So you can relate to your specific account. You can see that every month, guess what? Green, 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 green. You know what? The last time that I lost money in the market, and in fact, it was like in the futures market, was in 2018 when I was down, I think, and you could go to the stats and you can check that out yourself because it's in the stat. And I think I was like $500 under or something like that. $500, guys. And the rest of the months, you're going to be shocked, but you saw the profits, 25,000, 12,000 per contract. All right, so let's continue here with some, okay, let's see if I could do this. Okay, here we go, into presentation mode. So we identify the best opportunities every day. This is a trade that we took today. You can see we traded the Dow today. Dow had that synchronicity and the relative strength. and it popped higher. Uber is another trade that we called 2 days ago with really beautiful profits. We actually saw a dark pool activity into it, and we saw a block trade into it. Plus, the pattern was setting up, and it was actually a trade that was setting up, believe it or not, on the 2-minute chart, and we took it as a swing trade. Really small risk, massive profit. We're still in it, by the way. And I'm going to tell you, so I haven't looked at it right now, but if it trades over today's high, it's going to go back into the highs. So here's the thing. There's always someone that is on the other side of our trades. Volatility is what pushes the price faster into targets. It is the #1 opportunity for the astute trader. I have traded the 2000 to 2002 dot-com bubble. I've traded the 2019 market crash, thrived into it. 2009 market reversal through the QE years following that, election years, Brexit, China trade war, 2018 volatility, 2020 pandemic with massive gains. And here I am today showing you and putting the proof right there. You could go through the stats and through the trades. So making money in any market. I don't care if the market is going lower, if the market is going higher, if the market is sideways. We have strategies designed for that. So trading is a recession-proof skill. Now, there are many analysts that are saying that the market may enter into a recession next year. Okay, so we're gonna just leave it at that. I'm not gonna get too much into it, but prepare. Okay, so do what you have to do. So day trading is an income producing style of trading versus swing trading or investing, which is wealth generation. So when you're day trading, you're going to trade small time frames, 1 minute, 2 minute, 5 minute. Don't go into tick charts. Those are going to be really small profits. These are chicken profits. You're not going to make money in the tick charts. Trust me on that. I have not yet found or met a trader using tick charts for profits. Not one. Show me the money, show me your account, show me your stats, and then talk about the tick charts to me. Income producing style of trading, because you're in and out at the end of the month. I pull my profits out, pay the bills. Supplemental income. So if you have a full-time job, you could still day trade in the evening, or you can put on a day trade within a 24-hour cycle. You can trade any market, whether it's trading or volatile. In swing trading, you're going to focus on bigger time frames. So you're going to focus on daily charts, weekly charts, monthly charts, quarterly charts, your bigger time frames. This account is for wealth generation. And I highly recommend, like, for example, for those of you guys that are day trading and swing trading, have separate accounts. Because you don't want to put your day trader's hat when you're swing trading. So that's going to affect your bottom line. You're going to have the tendency to micromanage your position. Obviously, in swing trading, you have to trade trending markets, right? Because you need to stay with the trend. The trend is your friend. And then, of course, capitalizing on opportunities. So here's the question. Here's the $1 million question. Can volatility be forecasted? There is a way to know when to expect these kind of moves. And although not with exact precision, but volatile moves at times are predictable. So what do we know about volatility that from this presentation today is that volatility starts with any kind of FOMC meeting. Volatility will be in the market with any option expiration. Volatility will be here on any end of the quarter with any window dressing effect and any balancing. Volatility is going to come here with any kind of event, just like, for example, we just talked about election. We have the 2022 election, and that is going to create a volatile year. And I think those are those in November, I think, right? So as we're getting closer to summer, you can expect some kind of stall in the market, and then you're going to expect some profit taking. So that means it is time to go VIX long. So how to trade volatility? Long-term investor will use hedging strategies to minimize risk, inverse ETFs, like SQQQ, for example, or the VIX or VXX. I like to trade VXX because I don't like to trade options. Medium-term traders will speculate on volatile moves by buying pullbacks into key reversal-prone support zones in uptrending markets and also use hedging techniques. Day traders will trade both facets of the move. They will be ready to take profits quickly as the market conditions may change fast. What are the cons of volatility? Well, traders may often stop out because of the steep risk. All right. And because they need to maintain the long-term bias for trades. Stops are far wide, risk is high, reward levels have less odds of making the trade. So this way, it makes the trade asymmetric and not worth risking. So what is an asymmetric trade for those of you that don't know? You're risking $100 and you're looking to get $50. That's an asymmetric trade. Traders that trade the tick charts, they're asymmetric traders, and that's why they are not going to make money long term. I promise you that. See, so the markets move fast, and it moves fast in a fast-paced environment. It's very hard even to get in or to take profit very quickly. Plus, you have slippages. So what that is that when the market has a ton of volatility into it, you're going to see the spread widen. So the difference between the bid and the ask. So when you're going to place a trade, even on limit or market, obviously on market, you're going to get slip big time, but even on limit, you're going to get some slippage. There's a cure for this. There's a cure for this. Reduce your risk exposure. So for example, use half of the risk. So look at your account size. And you know what? This phrase that I'm going to tell you right now, I'm repeating it so often. I feel like I'm on a broken record in the trading room. Look at your account size. See what your account size is. Then your risk per trade is 1% or 2%. If you're 3%, if you're brilliant, if you're a really good trader, use 3%. But if you're like a medium trader, use 1 or 2%. So take that per trade, guys. And position size, see how many shares or contracts you can fit into that size. That is position sizing. Minimize risk, sit on the sidelines when the market is fast. Do not ignore the news. Do not sit complacent and trade, say, oh, they're going to turn around. They're going to rotate at some point. They may not. You may have a downtrend that may wipe out your account. Use stop losses. Be diversified. So don't put your eggs in one basket. When I day trade, when I swing trade, I have a portfolio full of diversity. I don't just trade NASDAQ stocks. I don't just trade oil stocks. I don't just trade bank stocks, right? I have a diverse portfolio. So what that means is that I'm not buying JP Morgan, American Express, Morgan Stanley, blah, blah, blah. No. I take, for example, I take a trade in Apple, I take a trade in XLF, let's say I take a trade in whatever, okay? So be diversified. Non-correlating assets, do not pull, non-correlating assets, so do not pull all your eggs in one basket. Like I said with NASDAQ, invest in high dividend stocks and make sure that you compile a list of high dividend stocks, because even when you're under, you're still going to get paid dividend on that particular stock. So that is fantastic. So if you have a long-term portfolio, that's what I do. So I have the third account, which is my long-term portfolio, in which I have, for example, some long-term stocks, long-term meaning that I'm keeping the position 5 years, 10 years, or 15 or 20. And I collect dividends. So I really don't care if that account is going down and if I'm having a volatility spike, because I'm getting paid dividend. So I'm making money without even working it, without even caring where the market is going at. And you have to prepare in advance for market crashes, and you need to know how to time the market. The difference between successful traders and unsuccessful traders is that successful traders always prepare. I use the weekend to prepare my trades. I do a lot of research. I work about 4 to 5 hours on Saturdays, 4 to 5 hours on Sundays every week. There's no exception. I don't take like long holidays and they go like, oh yeah, I'm in the trading room today. Let's trade, guys. Or, oh yeah, let's take some swing trades. No, the results that I have, they're coming from really hard work, but I love what I'm doing. So unsuccessful traders, they're uneducated, unprepared. They wing it. They go like, oh yeah, let's see what my friend is trading. Let's see what social media is trading. Let's see what Reddit is trading. You mitigate risk if you're successful, use position sizing, or you just ignore risk. You go like, oh, the heck, I'm just going to buy 500 shares. Who cares, right? I'm just going to buy 500 shares. If I lose, I lose, right? You don't love your money. And in this relationship with the market, you have to love money. If you love money, trading is for you. And you have to learn from failures, right? You have stopped out to analyze the trade. Don't just say, oh yeah, I stopped out, done. I'm not going to trade that stock ever again. Analyze it. See, why did you get stopped out? Is it you? Is it the market? I mean, what happened? Unsuccessful traders, they repeat failures. They love to do that over and over again until that account is gone. And successful traders always adapt. Unsuccessful traders, they don't adapt. And then successful traders believe in accountability. Unsuccessful traders, they take everything random. Here today, I'm going to talk to you about a power income futures trading course that we have upcoming for day trading. So we have two core courses that we teach, and this one is going to be with an early bird special, and that's why I'm presenting it to you. But I'm going to show you the other course that is for swing trading. We're totally sold out for September. The course starts next week, and we're totally sold out. We're always sold out on that course. We don't take many traders along on that ride. So we teach you an institutional grade trading system and how to trade stress-free, because there's no stress in trading. Literally, there's no, once you know the position size, once you know your entry, your stop, once you know where your targets are, and once you know, and you have a management plan, an assisted management plan, what's the stress? We're going to teach you precise buy and sell zones. We're going to teach you management and risk management. We're going to teach you highs, patterns, and setups, how and where to place stops, trading psychology, and how to put the puzzle together. This is something that nobody does. We're the only ones in the industry that actually take the time, and this is what we do in the last day of the course. We put the puzzle together, because when you buy a book or when you learn how to trade from someone, they're going to teach you, this is the buy, this is the sell, this is that. They never show you how to put the puzzle together, and then you learn everything. You take a 5-day course, 10-day course, and then you go like, oh, wow, I know so much stuff. And then when you're in front of the market alone, you go like, what do I do now? Because you have no idea how to put everything together in the market. And trading is about how fast you can put everything together. Now, how you put everything together, how fast you can put everything together. So we teach you guys the most powerful day trading chart patterns and how to exploit them for above average gains. We teach you the 6 major disciplines for every trade: the entry, the stop, the target, trade management, position sizing, and trailing. This is a bit cool. Wouldn't it be cool to know exactly what to do when your trade hits target 1? I mean, that would be fantastic, right? What do? You lift the stop. Where? Okay, so we answered those questions. We teach you market tempo. Yep, there's a market tempo. Market goes up and goes down, goes up, goes down, and there's a certain tempo because it goes in 15 and 30-minute increments in the morning. So it goes up 15 minutes, and then it goes pull back, and then it can go up for about 30 minutes, and it has a certain timing. So you know exactly when to get in and when to get out of the trade, because if you're expecting this reversal into a certain time, you're not going to stay long, because you go like, oh yeah, I'm hoping to get there. We're also teaching you how to maximize your timing using key moving averages and other powerful indicators that are free. They're free with any broker. How to maximize gains and minimize losses using proper money management techniques, market timing, precise timing, when to buy or to sell, when exactly is that perfect time, not only the location. So we teach you obviously the location. We teach you, so we have one day where we teach you advanced technical analysis. This is the only course that you will need, and the technical analysis that we teach you is from A to Z. A to Z. So the beauty about this course is that there's no homework. That's right. You don't have to do a thing. All you have to do is show up in class and come to the retakes. So it sinks in. Trading is about repetition. Knowledge is about repetitions. That's all you need to do. We're going to teach you everything from A to Z. You won't need another trading book ever in your life. Included with the course, we provide you with the on-demand recording. So the course is live every time. We're not going to give you a book and say, see ya. Or a recording says, hey, see, you know what? If you have any questions, yeah, just email us. No, we're going to give you the live class. You have the on-demand recording. You have an e-manual, which is about 460 pages. And that's only literally the tip of the iceberg. Because if I would put into words, for example, everything that I teach in the course, it would be probably 2,000 pages. And I'm not kidding you. It's that comprehensive. This is exactly what, if you want to get started into trading, this is it. And it's not me saying it. It's all the 5-star reviews that we have. We have group mentorship sessions. We have platform layouts, so you don't have to reinvent the wheel, because, hey, it's one thing that you learn how to trade, but how do you set your platform for optimum visualization of entries and stops and all that stuff? How are you able to see the multi-time frame alignment, right? You need to have a good platform layout. We're giving you that. Limited free retakes every time, come every month. And listen, successful traders come for the retakes at least 10 to 15 times. You need repetition every single time. Even after the 12th time you're in the retake, you're going to go, oh, okay. So you're going to have a light bulb. I promise you that. Support throughout your learning process. I'm here. I'm not going anywhere. I have a record. I've been trading for a very long time. Our company has been around for a very, very long time. You have risk charts, etc. The next course that we have is all the way in October 25th to the 29th. It's from 2 o'clock to 5 p.m. Eastern. It's a 5-day live event. We have an early bird special. The tuition is $4,999, and it comes with 3 months access to the trading room. And this is valid until September 30th. The tuition, then it jumps to $5,999. If you go on our website right now, and if you go under education and click on courses, you're going to see the course is $5,999. With this link here, you're going to have, and by the way, we're going to offer a bonus trading lab, which is a $1,500 value. It's yours for free. And sorry, I have the dates all wrong here. So if you want to visit the link, if you want to sign up, you'll only have until September 30th to get this early bird. Okay, this is it right here. It's TradeOutLoud.com/futures. And then, and I'm going to wrap it up here. I know I'm out of time. This is the page. So if you go under education, under futures day trading, you're going to see everything that we offer here. And not only that, but you can see the course is $5,999. But with that link, with TradeOutLoud.com/futures, you're getting $1,000 off. And then if you want to say, hey, you know what? I have the trading education. Thank you so much, David. I have the trading education. I just want to jump in your trading room. Yeah, it's fine. You could do that. And we have, you can see here the markets that we trade. We trade oil and we trade gold. Indices obviously are the bread and butter for day trading. You can read all about our program here. And then we have some programs, prices. We have an yearly. Most of our members go into the monthly, and then what they do is they hop into the yearly. So the yearly, obviously, you get 2 months for free. The monthly is $299. And if you say, hey, you know what? I don't know if this is for me. I don't know if I like her style of trading. I don't know if I like making money every day, or I don't know if I want to be consistent every week or every month. I just want a day pass. I just want to see what the room is all about. We have a $25 day pass. You can click it right here. Or you go like, I want to test it for a full week, 5 days. It's only $100. Okay. So $25 on the day. And if you want to, and these are not renewable. So these are 1-day trials, or this is just a 5-day trial. That's it. And this is pretty much it. And like I said, if you're into swing trading, stocks and investing, we have a course. The course is still $4,999. The price is going to go up in November on this one as well. And if you would like to hop in, for example, only into the stock swing trader and just have the trades delivered to you on a silver plate, you don't have to do any research, nothing. You don't lift a finger. You get all the analysis, you get all the trades with entries, stops, management, etc. Then you can go right here, and the membership is $199 a month, or yearly is $2,000. This is it for today, guys. Thank you so much for this presentation, and I will see you in the trading room or in class soon.